Imagine finding a stock trading at just $1.05 per share with a mind-blowing 19% annual dividend yield. That's 20 cents per share in annual dividends while you wait for potential appreciation. But here's the really interesting part. This is a mortgage REIT that specializes in short-term, secured real estate loans to property investors across the Northeast and Florida. A company with a book value of $2.47 per share, more than double its current trading price, suggesting massive upside if management can execute their turnaround plan. Now I know what you're thinking, why is it trading at such a steep discount? The company has been battling elevated non-performing loans and had to navigate challenging real estate market conditions. But here's what most investors are missing. Management just completed a $100 million senior secured notes placement, successfully addressing all debt maturities and positioning themselves with improved liquidity. They've reduced non-performing loans from $119.6 million to $104.1 million in Q3 2025 alone, and their post-COVID loan originations are performing exceptionally well. The analyst consensus price target sits at $1.48, representing roughly 41% upside from current levels, with one analyst maintaining a buy rating. More impressively, the company's diversification into strategic partnerships with real estate development firms is adding stability to their income streams. With operating expenses down significantly and credit reserves stabilizing, could this deeply discounted mortgage REIT paying a 19% dividend be one of those contrarian high-yield plays that rewards patient income investors who can handle volatility? But before I reveal which mortgage REIT I'm analyzing today, if you're new to smart investing, welcome. I specialize in finding undervalued dividend stocks, REITs, and turnaround opportunities that most investors are overlooking. I do the comprehensive fundamental analysis and research so you can make informed income investing decisions based on real data and emerging catalysts, not just market headlines. If you want to discover more high-yield opportunities like this, companies with real assets trading at beaten-down prices with massive dividend yields, make sure you hit that like button and subscribe to Smart Investing. New videos posted regularly covering the best dividend and value opportunities across all sectors. Now let me show you which mortgage REIT could reward patient income investors. The company I'm talking about today is Sachem Capital Corporation, trading on the NYSE American under the ticker symbol SACH. Sachem is a real estate investment trust, REIT, specializing in originating, underwriting, funding, servicing, and managing short-term loans secured by first mortgage liens on real property. Founded in 2010 and headquartered in Brantford, Connecticut, Sachem operates under a very specific lending strategy. They provide short-term loans, typically 1 to 3 years, to real estate investors and developers who need capital to acquire, renovate, rehabilitate, develop, or improve residential and commercial properties. These are essentially bridge loans for fix and flip investors and small developers. Their primary underwriting criteria is conservative loan-to-value ratios, and each loan is secured by a first mortgage lien on real estate plus personal guarantees from the borrowers. As of Q3 2025, Sachem's portfolio included approximately $364.5 million in net loans held for investment, primarily concentrated in the northeastern United States and Florida markets. The company operates as a REIT, which means they must distribute at least 90% of taxable income to shareholders as dividends, hence that incredible 19% dividend yield. Additionally, Sachem has diversified through strategic partnerships, including investments in real estate development firms that generate attractive double-digit returns. Here's where Sachem becomes an intriguing contrarian play for high-yield income investors willing to accept some risk. First, the valuation disconnect is massive. With a book value per share of $2.47 and the stock trading around $1.05, that's a 58% discount to book value. If management successfully resolves their non-performing loan issues and returns to growth, the stock could easily double just to reach book value. Second, they're making real progress on credit quality. Non-performing loans decreased from $119.6 million gross in Q2 to $104.1 million in Q3 2025, a $15.5 million improvement. Management is actively foreclosing on problem properties and converting them to real estate-owned REO, where they can control the sales process. The key Naples property representing about $50 million was undergoing mediation, which could unlock significant value if resolved favorably. Third, their post-COVID loan originations are performing exceptionally well with essentially zero defaults. The legacy problem loans are from the COVID era, and management emphasizes that their current underwriting standards are much more conservative. New loan originations maintain firm pricing at 12% interest plus 2% points. Fourth, the balance sheet has been strengthened significantly. They completed a $100 million senior secured notes private placement and used proceeds to retire $56.3 million of maturing unsecured notes in September 2025. This extended their debt maturity profile and improved liquidity positioning. Fifth, diversification is working. Their investments in partnerships like Shem Creek Capital generated $1.1 million in income during Q3 alone, providing alternative revenue streams beyond traditional lending. Currently trading at $1.05, SACH presents a high-risk, high-reward setup for aggressive income investors who understand mortgage REITs and can handle volatility. The analyst consensus price target of $1.48 represents approximately 41% upside, with ratings split between hold and won by rating. Ox the bull case. If management successfully resolves the non-performing loan portfolio, especially the large Naples property, and redeploys that capital into high-yielding new loans, the company could return to profitability and sustainable dividend coverage. The 58% discount to book value of $2.47 suggests substantial upside if credit quality continues improving. Even reaching book value would represent 135% gains from current levels. With a 19% dividend yield, patient investors could collect significant income while waiting for the turnaround. As interest rates potentially decline in 2025 to 2026, real estate transaction activity should increase, benefiting loan demand. The company's strong pipeline of new opportunities and conservative post-COVID underwriting suggests quality growth ahead. Strategic partnerships add diversified income streams that aren't dependent on lending activity alone. Face the bear case. The mortgage REIT sector remains challenged with elevated interest rates and economic uncertainty. SACH's book value has declined from $2.57 at the start of 2025 to $2.47 currently, indicating potential for further write-downs. If the Naples property mediation fails or other non-performing loans require additional markdowns, book value could decline further. The company reported a net loss in Q3, and full-year profitability remains uncertain. The dividend payout ratio exceeds 200%, meaning they're paying dividends from book value rather than earnings. Unsustainable long-term unless earnings improve. If the real estate market weakens further or recession hits, loan defaults could increase. With a microcap market capitalization of only $48 to $50 million, liquidity is limited and volatility is extreme. There you have it. Sachem Capital Corporation, a mortgage REIT trading at $1.05 with a massive 19% dividend yield and trading at a 58% discount to book value. With improving credit metrics, reduced non-performing loans, strengthened liquidity, and a robust pipeline of new lending opportunities, this could be an intriguing ultra-high-yield play for aggressive income investors who understand the risks. What do you think? Is the 19% dividend yield enough to justify the credit risk, or are the non-performing loan challenges too concerning? Would you invest for the massive yield or wait for clearer signs of a complete turnaround? Drop your thoughts in the comments below. If this analysis added value, smash that like button and subscribe to Smart Investing for more high-yield dividend and REIT opportunities. Remember, this is educational content, not financial advice. Always do your own research and never invest more than you can afford to lose, especially in high-risk, high-yield securities. Thanks for watching.